We're half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne with David Ingles.
Happy Friday. We got here our top stories today. Volatility gripping the Japanese currency as top currency officials play coy on intervention. Stocks across the region are down following a slump, actually, in U.S. tech shares overnight on fresh signs of slowing U.S. inflation. Now, President Biden says he is determined to seek re-election even as more high-profile verbal stumbles and further heighten, of course, scrutiny over his campaign. And China's leader is under pressure to lift confidence at next week's policy meeting with no signs the economic slowdown is easing and citizens venting their frustrations.
All right, you may remember back in that May inflation print, and Jay Powell said it was a very good one. Yeah. This one was better for June, and you're certainly seeing that across risk assets here. It gives another sort of boost here on what we're seeing across. But really, what you're seeing when it comes to equities is what really has been driving it lower is Japan and the likes of Korea. So that's really because what we've been seeing the movement in the yen. So it was a massive swing, right, from 161 to 157 at one point. We've pared back some of the initial gains already here. Of course, there is that whole suspected intervention that we're watching very closely. And it would be an interesting move from Japan, the way that they took advantage possibly of that weaker CPI print, the market reaction when the yen strengthened to actually step in. So we're watching very closely that. But yes, Kanda-san, the currency chief in Japan, not confirming at this morning that whether they intervene or not. We'll have to wait by the end of the month to see. But certainly when it comes to the bond market, they definitely like that news when it comes to inflation. And certainly we saw a little bit more of that steepening trend take place in the Treasury market. We're at 451 levels for your U.S. 2-year, as well as that 10-year now holding around 421, 422. Traders really now fully pricing in 2 Fed cuts by year end. It's basically going to be September, December. They're putting the odds at that. Even November, that's looking like close to even odds that we might see a cut there. So that's the question now. We've moved from maybe 1 to 2 to maybe now 2 to 3 cuts by year end after this CPI report. We're also watching very closely what goes on with the dollar. So certainly saw that drop. And we're watching euro. So 108 is where you're seeing euro dollar levels here right now. But it's really those yen pairs and crosses that we're watching very closely. So after that initial pop, things are slowing down just a little bit when it comes to the yen here. So we're watching Aussie yen, euro yen, renminbi yen as well. That's a key one to watch for those that are watching the renminbi very closely here this morning. And here's the setup, of course, to the China Open. Now, obviously, we're set, given the rally that we saw this week, to snap out of 7 weeks of losses for the CSI 300. I'm watching very closely the trade numbers that could come out any hour, any minute throughout the day. And, of course, that really drum beats to next week, which is a pretty busy week.
Yeah, with a third plenum coming up and, of course, other pieces of data, too, including, by the way, which we could get today as well, the credit numbers. We are still in the window for that conversation. We have trade, as Yvonne is pointing out, in terms of sectors to watch. Solar and EVs, you had a massive move up in the likes of XPeng overnight. Jinko Solar was also one stock that moved. Yum China. So we'll look at those specific names going into the open today. We do have a bond auction today of 5-year local currency bonds in China. So 2029 bonds in the order of a couple of billion. I think it's 60 billion or so, if I'm not mistaken. And, of course, we're going into this with some momentum behind us. We're looking at futures, as Yvonne is pointing out, 0.2% higher as well. Just one thing on the Japanese yen, too, of note. The Nikkei reporting about, I think it was about 45 minutes back, that a BOJ did conduct rate checks on the yen against the euro specifically. So just watch it closely because rate checks do signal that Japan is preparing to intervene in these markets. But yeah, back to the other top stories, of course.
Yeah, what we've been watching all morning really is President Biden's press conference that just ended maybe half an hour ago here. Obviously, there was a series or a pair of gaffes as well as his campaign tries to fend off calls for him to step down as the Democratic Party's presidential nominee.
Now I want to hand it over to the president of Ukraine, who has as much courage as he has determination. Ladies and gentlemen, President Putin. President Putin. He's going to beat President Putin. President Zelensky. I'm so focused on beating Putin, we got to worry about it. Anyway, Mr. President.
I'm better.
You are a hell of a lot better.
What concerns do you have about Vice President Harris's ability to beat Donald Trump if she were at the top of the ticket?
Look, I wouldn't have picked Vice President Trump to be vice president.
Okay, let's bring in Jill Deesis, our Bloomberg News desk editor, to talk us through the whole. Let's call it a show. It lasted about 3 hours, give or take, and the focus was supposed to be on policy and NATO. And Jill, obviously, unavoidably, we need to be talking about some of those gaffes as well. What do you think the key takeaways were for you, just looking at this collectively, of course?
Well, look, David, I actually think, the big issue for President Biden here is that gaffes like the ones you just saw there overshadowed some pretty cogent points on foreign policy. I mean, he addressed issues such as, this push to cut investment into China if it continues to support Russia. You saw, that is obviously very top of mind for a lot of U.S. policymakers coming off the back of that recent Xi and Putin meeting in Kazakhstan. He also talked quite a bit about the war in the Israel-Hamas war there. But of course, when all attention is on the president's mental acuity and all of these different gaffes, I mean, when you're calling your own Vice President Trump, obviously referring to Kamala Harris there, that certainly is overshadowing there. And I don't really know that the state of play in Washington right now, this idea of this sort of mounting pressure from a lot of these Democrats to push Joe Biden to step off of the ticket, to be replaced with someone else. I don't really know that the state of play really changes there when you've got those types of flubs being made on a world stage like that.
Yeah, I mean, it was seen as some sort of a make or break moment for Biden, Jill. I'm just wondering, when it comes to U.S. allies, how are they looking at this right now? Would they prefer a weaker Biden or President Trump at this point?
Well, I think at this point, I mean, a lot of European allies are pretty much probably just looking there and saying, what exactly is happening here? I mean, you've had reporting in other news outlets, including recently the New York Times from the G7 meeting in Italy just a few weeks ago, saying, look, we're not really sure, he doesn't really seem like, his old self there, referring obviously to President Biden. But of course, former President Trump was obviously, very, very volatile in office, a very, very different approach to policy making there. And then you also look at what's happening, during, Donald Trump rallies. I mean, you still have a lot of those same issues, with regard to, how coherent is he on policy necessarily. You've got, Trump floating things such as, incredibly massive tariffs on China. It's a very, very volatile thing at this point. And I think, also just lending a lot of uncertainty to what exactly the United States looks like as a world power going forward, depending on whether you see, a weaker Biden in office, if he were to win re-election, which of course the polls show at this point incredibly unlikely, if that were to be replaced with Donald Trump, if he were to return to office, or if it be some other candidate, which of course, we're not really sure what that will ultimately look like, given you've only got, 5 or 6 weeks before the Democratic National Convention actually takes place.
And Jill, we also heard from the president his take on China, particularly around, of course, you mentioned weakness, Ukraine in the South China Sea. Let's listen in.
You have to make clear China has to understand that if they are supplying Russia with information and capacity, along with working with North Korea and others to help Russia in armament, that they're not going to benefit economically as a consequence of that by getting the kind of investment they're looking for. We have to make sure that she understands there's a price to pay for undercutting both the Pacific Basin as well as Europe, and as it relates to Russia and dealing with Ukraine.
And Jill, given that, how should investors now be approaching scenarios, whether it is Trump 2.0 or, again, another term from Joe Biden?
Well, David, I think that, once again, that particular answer on China may be, one of the stronger points out of this press conference from Biden here, this idea that, the U.S. could cut further investment into China there, should it continue to support Russia. I think you have to kind of look holistically at what the Biden administration has ultimately done on China. I think Trump himself has pointed out, that Biden didn't exactly roll back the tariffs that were implemented, on the world's second largest economy there. It's actually been, a fairly tough administration when it comes to trying to curb China's access, to things such as advanced tech. Obviously you've got Trump again saying that, if he were to win re-election, that he would also just, introduce and really heighten tariffs on China, get tough on China. The general attitude from the United States towards China right now does appear to be one that is willing to sort of step up some of these curbs on China and on, Beijing and President Xi Jinping, and kind of, continue to have tensions simmer there, despite recent efforts in, over the past year or so to try to reopen some lines of dialogue.
Jill, thank you. Jill Dees is our news desk editor joining us from Singapore, just wrapping up that Joe Biden press conference for us. And of course, another top story for us is really what the market reaction is dealing with here, not just when it comes to politics, but that US CPI print, which really did, I guess you could say, surprise the upside when it comes to just how big of a cooling that we saw in prices. So we actually fell, this is the headline number, a negative print of 0.1% in June, which is basically the first negative print we've seen in about 4 years or so. When it comes to the core CPI, it was just up about 0.1%. It's the smallest advance in 3 years. Certainly what was behind that, I think some are really noting that downdrift that you're seeing in shelter prices, rents, car prices that really kind of helped these numbers. Yeah, and really coming in below forecast across, particularly when you look at the month-and-month gauges as well. So let's get a sense of the cut from the Fed is indeed coming in September. Johanna Chua is here with us, head of emerging market economics at Citigroup Global Markets. Good morning. The house view from Citi is looks like you guys will turn out to be correct.
No, absolutely. We've been more dovish than consensus. Having said that, we did move a little bit our timetable to September cut as our first cut. We still had 3 cuts this year. The market now is pricing in a little over 2.5 cuts.
Closer to 3?
Yeah. Closer to 3, but again, it's a bit of a mixed view. And, I think now, if anything, the data that we saw from the CPI, and we're expecting right now core PCE will probably come around 0.13% month on month. We're waiting for US PPI data today to kind of cement our view on where core PCE. But pretty much, I think September is going to be a done deal. And the question is, what's going to be going forward? But I think it's shown that the recent softer data we've seen kind of says that maybe the first quarter inflation upswing that we had in the U.S. was a bit of an aberration. And I think you're absolutely right. I think that the softening we've seen in the housing is going to be very, very encouraging for the Fed. And I think that really kind of helps a little bit cement our view. I mean, obviously, there's still a lot of uncertainty about the visibility going into next year. But on the back of that, I mean, I think this is, for a while we were kind of a little bit, wary of how much adding more on the duration risk ahead of a U.S. election. Yeah. I think after the CPI, after what's happened in the market, we're adding a little bit more duration risk, for example, in Asia, where we added a little bit overweight position in Indonesia. So just at the margin, there's some of these tactical trades that we're kind of a little bit more favorable at the moment. Again, before we kind of play into these Trump trade risks.
Yeah. How confident are you that inflation is going to head to that 2% target in a sustainable way?
I mean, look, there's still obviously some risks that we need to watch out for. It's not like it's going to go to 2% right away. But I think the direction of traffic is that it's kind of heading towards kind of the 2.5% core PCE by the end of the year. We are kind of trajectory kind of going into that path. And having said that, Fed fund policy rate is still quite high. I mean, you don't need to get to 2 before you start cutting. As long as you're kind of heading towards that direction, I mean, there's enough room there with 5.5% policy rate. And it's not just the inflation. I mean, you look at the data in the labor market. There definitely are signs that things are cooling. And I think the signal from Powell is, you're not just only supposed to care about inflation, you also have to manage what's happening with the job market.
How do we now look at external demand, particularly import demand out of the U.S., as we look at, some of the export-oriented economies this part of the
so
world?
It's interesting. I mean, if you look at some of the goods demand coming in the U.S., it was already weakening. I mean, it was already weak even prior to this latest slew of weakening data. I think there was a lot of debate to what extent can Asia withstand kind of a U.S. slowdown if it ends up a much more rapid slowdown. Right. And again, of course, it depends on whether we're envisioning a hard landing or a soft landing. But I think there are some kind of other counteracting effects that's helping cushion the business cycle. Yeah. As you know, we have still a very strong tech tech cycle, at least parts of the tech cycle. Certainly stuff related to AI has actually still been very strong. We've had still pretty good data out of the tech data and exports, not just in Korea and Taiwan, but we're even seeing a little bit of spreading good data, for example, from Singapore, Malaysia, for example. Beyond that, I mean, look, I think the world has become so desynchronized, right? The pandemic created a lot of desynchronized effects. For example, a lot of emerging market countries hiked a lot earlier. Some of them are obviously cutting earlier. So you have these kind of desynchronized cycle that some markets in EM and kind of the global south, actually domestic demand has been held up by the lagged impact of policy easing, even as the US now is kind of on the other cycle, which is going to be on the belated easing cycle. And the other thing we have to watch is, again, some of the pattern of goods versus services, how it became so desynchronized because of the pandemic rather than previous business cycles where they tend to move together. Could create a bit of a cushion. Now, of course, I don't want to be dismissive and say, we're not going to be impacted. If the U.S. catches a cold, we know we're not going to sneeze. But again, the issue is, I think there's a little bit of an offset, and there is a relief from having a little bit of relief from lower U.S. rates.
Yeah. I need to do some mental gymnastics on the timeline, on the lag and everything else. We'll have more, of course, from China, Chua, in a moment. There we'll talk all things, of course, Asia-Pacific, China. Of course, we have trade numbers coming through as well today out of Beijing. Right, just ahead of here on the show, just counting down to the open of trade, and the bottom of your screens is your reference rate of the day on the PBOC. The open is, wow, look at that. That is a view of Victoria Harbor, and looking like a bit rainy weekend. What do you think?
Hopefully not.
So hopefully it's not as hot.
But it may cool down the temperature.
I've been melting into my socks the last few weeks or so. So looking like the markets too are called higher here, 0.3%. This is the China Show. Happy Friday. Welcome back to shows. You're watching the China Show. Still here with us here on set, Johanna, Chua, head of emerging market economics at Citigroup Global Markets. Let's look at China. The recovery's taking longer than expected. There's a third plenum next week. Does it feel like this economy's aged overnight, like pre-pandemic, post-pandemic? Suddenly the mindset of consumers just looks completely different coming out of the pandemic than it did going into it.
Right, no, absolutely. I mean, we've known that, right? Because obviously the pandemic coincided with massive correction in the housing market, lots of regulatory state intervention, heightened geopolitical risk. It's not like Biden really lowered the temperature that much. So we know that that's been happening. And again, what the issue was, that the frustration that people has had is that why haven't policymakers counteracted those kind of domestic demand shock with more aggressive policy intervention, like more policy support? And that was a big story last year. Then they had the amended budget, and then we did get a little bit more policy support in the beginning of the year. So first quarter GDP growth and data in China was actually better than expected. But I think going into 2Q, it started to soften a little bit.
Yep.
And then even though we had a lot of these policy measures on property in mid-May, the data hasn't really panned out yet. So we're kind of going into third plenum thinking, we're losing a bit of momentum on the growth. We need a little bit more kind of a little bit more fuel. Are they going to do something? I think that's kind of where there's hope and expectation, but at the moment, I think the bar is very high to really dramatically surprise people going into third plenum. I think people are kind of managing their expectations. So I think that's the thing. I mean, third plenum, we're waiting more for structural reform, and then we had mid-year Politburo meeting, which is really where we're going to see more signal of the policy support. So we're watching third plenum to see what the signals are. There fiscal reforms? Are there more material reforms to kind of rejuvenate private sector confidence? I know these things take time, right? It's not very easy to kind of turn around private sector confidence. But lately, there's been some noise on fiscal reform. I mean, we've written a note recently about this. There's been a lot of chatter about consumption tax reform, and maybe that could be a way to help beef up local government finances by giving them more kind of revenues from consumption tax.
Right.
But again, consumption tax, which maybe will be geared towards more high-end consumer goods, but that could dampen demand at the same time, right? So there's a bit of a trade-off with giving more local government support, but then what does that mean to high-end kind of end prices and demand? So there's a lot of noise about that. And then mid-year Politburo, we're hoping for, because the property data, the real estate, kind of property activity obviously has been a bit, discouraging. So we're hoping that, after the mid-year Politburo meeting, maybe we'll get another round of kind of property support. But that's where we are in China. I mean, it seems like we're looking for a little bit more kind of policy support just to keep the economy going. And the question is, how much will that really bolster confidence? Because you've got a looming U.S. election coming up. And people are also worried what the ramification of that will be.
And it seems like, even even when it comes to the outlook for exports, right? That this whole prospect of tariffs in the U.S. has really kind of put a taint on how this export growth can be still a pillar of growth for China. I'm just wondering, how are you gaming out these scenarios now around this U.S. election?
But, I mean, actually, well, first of all, on exports, the ironic thing is actually exports in China have been doing fairly well this year so far. And I think part of it is because, again, the tariff is more of a delayed risk. There's actually a risk there could be front-loading, which actually could make the exports do a little bit better. So if people anticipate that there could be a tariff Trump, you could have a bit of a restocking of inventory. That could help some of the numbers. But the question is, what does that mean for 2025 if these tariff risks come through? And it's not just the impact on exports. We also have to assess what it means for manufacturing investments, because obviously as a way to maintain competitiveness, you hear a lot of news, right? Companies like BYD thinking, investing in Turkey, investing in Thailand. So there could be a little bit more concerted push of companies to move some of the production overseas, which means that there's at the margin a bit of a hollowing out effect of what does China's export competitiveness mean in translating to GDP growth is some of that production moves overseas. So these are things that I think, the Chinese policymakers have to think about. But for 2024, I guess it hasn't really been a big threat to the GDP growth numbers, because actually, if anything, it's still been supportive. But it is a looming threat you have to think about in 2025, and how are they going to balance that? So we are watching very closely these tariff risks. I mean, the stuff that Biden announced, we're not really very worried about this tariff, because again, China doesn't really export a lot of EVs. But if Trump comes in and we get a lot of noise on broad-based tariffs of 60%, I mean, it's bad for both the U.S. and China. Those are things that we obviously have to worry about.
Johanna, we've got to leave it there, but thank you so much. Johanna Chua there, head of emerging market economics at Citigroup Global Markets. Your pre-market in Hang Seng, Hong Kong, is opening up, and it looks like we are joining in with this global risk rally that is extending for another day here post US CPI.
Ex-Japan, though.
Ex-Japan, yes, because of the stronger yen. 1% pop, though, when it comes to the Hang Seng here this morning. Plenty more ahead. This is Bloomberg.
Right, welcome back to the show. So here's an interesting divergence we're seeing across price action, right? So what looked to be good for equity markets, well, what was suspected to be have been a good thing for equity markets turned out not to be, which was a CPI print that was on the softer side of things. So that came in, that pivoted to the bond markets, and that rally, of course, that we've seen in the bond space. But interestingly enough, so you had the drop in mega cap. You are seeing a substantial drop today in Asia Tech ex-China, because those benefited from the sort of yield AI conversation. It now seems like it's favoring China too.
It's interesting, though, that there was this swing in the U.S. markets from big tech, the winners, straight to value, right? And you're seeing that in the small caps and the like here. And so is that sort of a sign of where this risk rally is taking place here right now? In terms of stocks to watch here in the region, we're focusing on earnings still. So the likes of Air China, Sinopec, Poly Developer, as well as Chalco as well. Not seeing a huge reaction, but Chalco, there you go, up some 6%. JP Morgan also upgrading that stock. They think that the company could raise that full-year payout ratio after, of course, earnings did beat. We got the open coming up next. This is Bloomberg.
I do think China has to earn its way back into growth investor portfolios with more incentives for those who have great ideas and want to deploy them in China as opposed to elsewhere in the world. I think China will get it right, but it has been very discouraging from an innovator point of view.
And that was Cathie with it just over her left shoulder. I'm not sure you guys noticed that, of course. Hanzi, I think.
Yeah, I saw.
Right? Couldn't quite read it, though. Cathie was there speaking earlier to us during a recording to our Tiger Money podcast. The full episode, of course, airs in a couple of weeks. She talked about a lot, including does she regret selling out of NVIDIA? What does she think of Elon Musk? And also, is there key man risk as far as Tesla is concerned there? She is, of course, extremely bullish on the Tesla story. Going into the open today, we're looking at declines here on the CSI 300. So we were set to snap a 7-week skid at about these levels. We should be on the fence right now. We could clock in an 8th week of losses going into the close of the day. It's very early, of course, the first few minutes of trade. A couple of things coming out today. We have trade numbers at some point, and we also have a bond auction on deck today, 2029. 5-year bonds are being sold today. That's the mainland story for now. The Hong Kong story is looking like this, where you are getting really an uplift as far as tech is concerned. 1.4% in the early goings on HS Tech. Tencent, Alibaba leading those gains as well, AIA. So what turned out to be not good for U.S. equity markets and Japan on the stronger yen turned out to be a good and blessing here for the Hong Kong markets. 1% on the MSCI China, which puts us on track for a weekly gain, by the way, in the Hong Kong markets. Right. A couple of things to track right now. So we talked about tech, right? So we're just pivoting away from, and we'll take you back to China in a moment, but away from the Chinese markets very quickly, and to our point earlier on, you know, the winning rally on AI turned out to be the CPI print overnight, turned out to be the temporary wall. So we're seeing some profit taking across these big names, hence why we're seeing Taiwan is down, hence why we're seeing Korea is down, hence why we're seeing Japan is also pulling back on the stronger yen as well. Now, back to China, you had a couple of big movers overnight. The big moves in the ADR market are maybe translating to the open today, and there they go. As far as that's concerned. Very quickly, earnings coming through. You had the big 3 airlines, Air China, China Southern, and China Eastern, all guiding towards losses to varying degrees. Declines across, those are the A shares you're looking at on your screens, and Pulley Real Estate up 2%. That also guiding as far as a drop in net income is concerned.
Yeah, let's talk more about these markets now and get our Asia stocks reporter Jeannie Yu, also our China correspondent Min Lo, joining us now. Jeannie, I'll start with you. We mentioned about this disparity that we're seeing, right? U.S. tech sold off, but HS Tech is really actually doing quite well in light of these US CPI numbers. What do you make of it?
I think this is one of the key things we're watching out for in China market today. I think one of the key reasons is that all the leading China tech names, they didn't enjoy the rally pretty much. And all the money has gone to all the semiconductor names. Like, for example, like TSMC. Right now, we have seen like 5 consecutive days of foreign outflow from the TSMC's Taiwan shares before its earnings next week. But like in China tech's case, you know, Alibaba, Tencent, like all the global long-only funds, they have been cutting their weight in the exposure to those names. So I think after some rotation happening, you know, we could see some rotation, you know, from those kind of overheated semiconductor names and back to, you know, potentially those China tech names, which has relatively, you know, much cheaper valuation, and maybe some investors think it's time to, you know, buy back some of those shares.
Min, we talked about economic data. We're waiting for trade numbers.
Yes, exports is actually looking to be very positive for June. In fact, it's expected to grow by 8%, up from 7.6%. And this is the strongest print we are expecting in 15 months. So from all the way back in March of last year. And this is really aided by very strong, very favorable base effects, because last June, export had plunged by 12% and above. And also it reflects that broader geopolitical environment, because you have all these manufacturers really trying to front load all their exports ahead of all those impending tariffs, because you have Biden's tariffs, the first phase of it kicking in August. You have those EV tariffs from Europe kicking in July. Imports also expecting to increase as well, and that is likely because these factory owners also trying to import more shipments for finished goods for exports. So it's the bright spot in the economy now, but again, there is, you know, stronger headwinds heading into the second half, because we see global economy slowing. PMI in US and Europe are contracting, in Japan as well, hitting that middle point of 50, and China's PMI as well showing new export orders contracting for 2 months, so 2 straight months, so some unpredictability ahead.
Well, of course, next week's going to be huge, right? You talk about the plenum, we have big data down. Set up the scene for us, but what's it looking like?
Yeah, so we have a lot of data coming out, economic data, home prices, MLF, so all of this coming out as these hundreds of central committee members are gathered in Beijing for that 4-day plenum. So lots of pressure for those policymakers, because economists are now calling for stronger measures that could really move markets. This is fresh from a Bloomberg survey of economists. They're calling for more measures to rescue the property sector, a ramp up of that May rescue plan to really inject trillions more money money into the market as opposed to that 300 billion yuan relending facility we've seen so far. They're also calling for more measures to address local government debt and to shore up China's technological self-sufficiency. Because if you look at the eco data forecast for Monday, most of those are pointing downwards, including for fixed asset investment, which suggests there's a limit to how much local government can continue investing to lift the economy. And then, the government has pledged a more proactive fiscal policy, but so far spending has still lagged behind the budget deficit as it did last year as well. And Morgan Stanley just came out with a note warning about possible currency devaluation in the coming months. So plenty of unpredictability again, and uncertainty due to geopolitical risks as well with the US elections coming up.
And Jeannie, the people that you talk to, what are market expectations going into next week? High, low, justified, no expectations?
As we chatted yesterday, the China ETFs in the U.S., they have been seeing consecutive weeks of outflows. So I think actually, and Morgan Stanley today, they have published a note saying, actually Asia sentiment is pretty range bound, before the plenum. And sentiment is not actually picking up very, very meaningfully. But in the meantime, after the short selling ban yesterday, we might see like the government want to show more signals in the market. For example, those ETFs favored by national team, we might see like volume picking up again today. So it could be like another signal for the markets that the government really wants to prop up the market. So I guess so traders still have some hopes, and especially for the plenum, they're still watching out for some supportive measures for those, like for example EV markets, renewable energy, like those kind of sectors. They're still like expecting some policy boosts.
Next week, beyond just what Min mentioned, we also have earnings to talk about. TSMC, that's going to be the big one. Given what we saw in the June numbers, are we likely to see enough in these earnings to really justify this rally that we've seen in the stock?
Yeah, to be honest, like when we talk to all analysts and investors, no one says anything bearish about TSMC, which is not surprising. But to be sure, like I just said, like TSMC has actually attracted 5 consecutive days of foreign outflow for its Taiwan shares as of yesterday. So I think this is part of the sign that investors are starting to get uneasy. So I think that currently the major debate in the market is whether TSMC is going to raise their full-year revenue guidance in the earnings call next Thursday. So if they're going to raise, I think that would really help its shares to continue rally, after a 7% increase year to date. But if their tone is slightly more like neutral, and they maintain their revenue guidance, that could be a little bit disappointing to some brokers, because we have seen Morgan Stanley, JP Morgan, they have all hiked their target price into the print, expecting them to raise their sales estimates. But yeah, so let's see.
By how much they will, right? Jeannie, thank you so much. Fantastic there. Jeannie, you and of course Min Lo here on set for us on the equity market and the outlook for such. Let's pivot now to FX markets, and certainly the big story overnight was the drop in the dollar. And did Japan place an invisible weight on dollar-yen overnight to hasten the move into where we are currently? Although as you can see, we're slightly then weaker now, up to about 159.28 on dollar-yen. Euro-yen's also very much in focus. The Nikkei reporting, we're also hearing from traders that the BOJ did conduct a rate check on the yen versus the euro a couple of hours back. Let's bring in David Finnerty, our FX and rate strategist. Yeah, David, are they intervening? What past tense, present tense, what are we talking about here?
Well, there's certainly a lot of speculation. There's no question about that. And I think what's interesting with the speculation, you have to remember before we get to that Japan is on the US Treasury's currency watch list. So the US Treasury, whether they intervened or not, has warned them not to intervene unless it's exceptional circumstances. And if they did intervene, then it's very questionable whether that meets the exceptional circumstances criteria, given that the yen was rallying rather than weakening. seen. So time will tell. In terms of speculation, you said there has been rumours that was a rate check today. There's definitely rumours circling around trading desks that basically 40 to 60 billion may have been traded last night by BOJ intervening on EBS, which is a trading platform. So we haven't corroborated that, but certainly a lot of rumours going around that that may have taken place. So you are seeing the yen obviously weakened overnight, but you see now today it's retracing some of those moves. And what's interesting, if you look at even in the option market, going into yesterday, earlier this week, hedge funds had bought dollar yen puts, which basically are option contracts that benefit if dollar yen rallies. And purely they bought that as a hedge. They had underlying long positions, and they bought them as a short-term hedge should an event risk like yesterday CPI turn out. Obviously it did. Now the question is, after the CPI data came out, I spoke to some of my contacts in London last night, and they said actually the flow was very two ways after that. It wasn't very directional. So it was like, well, yes, they had the move, but the sentiment on the hedge fund wasn't necessarily it's going to continue downwards. And now today you'll see it go higher. So the market is very mixed in terms of how this plays out, whether there will be more intervention. And of course, the question is, even if there's more intervention, how long does that last? History has said, look, it's a short-term gain, but long-term, you can't change the fundamentals of where the market is. And with US yields remaining still elevated, the bias is still maybe towards dollar yen grinding a bit higher.
Intervention or not, we saw moves in the dollar post US CPI. Any signals there, David, that you think these moves, a weaker dollar is actually sustainable at this point?
Yeah, well, I think a key thing actually will be the US PPI today, because that's important because that feeds into core PCE, which is the Federal Reserve's preferred measure of inflation. So I think if that supports the case of slowing CPI, look, traders have shown consistently they're more than happy to price in Fed rate cuts if given any chance at all. And yesterday we saw them go from 2 to start pricing in 3. If PPI comes in weaker than expected, I think the chances of 3 will certainly increase as far as the traders concerned. So that will see US yields push lower, which will add weight to do dollar yen and all the dollar trades. So dollar weakness, I think, has room certainly to move forward. Certainly traders would love dollar to weaken. A lot of traders are waiting to short the dollar. But again, I think one piece of data is not by itself enough to really back that trend. But I think if PPI comes in, again, that's an if it comes in weaker than expected, then I think you may find more people jumping on this sell dollar bandwagon.
Yeah, and we still got these 2 CPI prints and jobs reports before that September FOMC meeting as well. Doesn't contend with. David Finnerty, thank you. Our FX or rate strategist joining us out of Singapore. We got plenty more ahead. This is Bloomberg. Welcome back to the China Show. Looking at Tesla suppliers in the region this morning after, of course, we did hear from Tesla, well, at least what happened with the stock overnight was surely a sell-off there. We saw shares down more than 8%. Perhaps it was what we saw with that US CPI print, but there was also an interesting scoop from Bloomberg about delaying that Robotaxi event. Could be a blow, of course, to this whole autonomous driving push from Elon Musk. Let's get more on this with our tech reporter, Annabelle Jewelers. Overall, I mean, it was supposed to be August 8th that we're supposed to hear an unveiling. What are we hearing? What's behind this delay?
Well, essentially, we're hearing that design teams have been asked to make a few more tweaks to the car. But I think you've kind of got to put it in the context of all the pronouncements we've heard from Elon Musk over the years, because they've been talking about a robotaxi going all the way back to 2016. But every single deadline that has sort of been set and then missed. But yes, essentially, there are a lot of questions about this robotaxi. We don't know what kind of price point it's going to come in at, what kind of features it's going to have. Is it even going to have a steering wheel? So the delay, I guess, if it's 2 months, perhaps that's fine. If it's longer than that, that's really the question here. And perhaps part of that share price reaction today is investors are clearly very nervous about it.
Yeah, and he staked his future on this project. And, when markets look to price, is it still an EV play or is it an AI play? This determines that conversation, doesn't it?
Yeah, that's right. I mean, Elon Musk, as you said, he really believes in this vision. He believes in robotaxis at the expense of pursuing cheaper models, like a $25,000 car that could actually help the car grow in that EV market. As you say, there's that case. Can Tesla really make that real-world application of AI come to life? And that's what investors kind of buy, I guess, because this is one of the most expensive stocks in the S&P 500. It's trading around 90 times forward earnings. And so you're not really buying what you see in Tesla today. You're buying that vision that he's setting out.
Yep. Assuming he executes, to your point. Right?
Well, that is the point, and that's what people are clearly concerned about. And you think about sort of the industry around it. There's the likes of Cruise, Waymo in the US that have been working very hard, spending billions of dollars, and people are saying this could be years away.
Okay, Belle, thank you so much. Annabelle there with the latest on Tesla. Now, the leader of Samsung's largest labor union says that the strike action is disrupting production and causing equipment to go idle. The union chief spoke to us from Seoul about why workers have walked off on the job.
It's been a long time since we've been negotiating, and it's been a year since 2023, and we haven't been able to sign a wage agreement. Despite that, and despite the fact that we've launched an indefinite general strike, the company seems to be thinking that they can win if they keep biding their time. We're going to continue with the general strike until the company comes forward.
Where could you find compromise to get to a resolution?
Since starting the wage negotiations, Samsung has never negotiated properly. We haven't been able to get a good negotiation in 2023 and 2024. So if we're going to get a deal this time, we basically need a pay raise for our members. We are not asking for many things. The company unilaterally announced 3% increase, but we are asking for a little higher, 3.5%. There is no transparency about the bonus pay system, so there are many complaints from employees there. So we are saying, let's improve the system with transparency. And for the most important, holiday rights, we're asking for 1 day for the union's establishment anniversary. So if we can get a resolution here, I think that's something we can agree on. And I don't think that we're asking for anything unreasonable.
Your union has targeted production disruptions, but Samsung says that they haven't seen any production disruptions so far. How will you achieve your goals then?
We're getting a lot of reports from the field. Like in the 8-inch manufacturing, a lot of current shift workers, people who work in manufacturing, a lot of them are on strike right now. So we don't have enough people to manufacture on that line. It's a manual line, so it's not automated. So that's where you need people. And they're taking a lot of people out of the office right now. And I know that they're not responding properly. And in another line, I'm hearing that there's a lot of equipment that's shutting down, but they don't have the manpower to handle it. So there's a lot of equipment that's going idle. And when you're producing semiconductor parts, obviously you have to do inspections and things like that. And there's a lot of that backlog right now. So there's definitely going to be quality issues.
We heard your union is getting advice from a former union leader at Hyundai. What sort of guidance are you getting from unions of other conglomerates in South Korea?
We're cooperating with other unions as well as Samsung-affiliated unions. And we're working with the Korean Metal Workers Union, which is where the Hyundai union is. We're getting a lot of help. And we're getting a lot of help from unions that have a lot of experience in this kind of thing. Because we're a new union, and we're leading this general strike with that help. We're going to continue to expand our solidarity with other organizations in the future.
Samsung workers usually get higher pay, also higher benefits than workers at smaller companies in Korea. Are you concerned that the rest of the country might not really sympathize with your demands, especially at a time when we know that Samsung semiconductor exports could actually help the broader Korean economy?
We're not worried about that. We're in a labor movement, and I think it's fair to say that we're fighting for the rights of all workers in Korea. Samsung Electronics is known as the best company in Korea. And if the wages are not raised properly, even at the best company, then the countless suppliers and small and medium-sized enterprises under them will not be able to get a proper wage increase. So if we raise the wages, then other companies will have a cascading effect. So Samsung Electronics is at the most important crossroads to raise the wages of the most important workers in Korea.
That was the National Samsung Electronics Union head Sung Woo Mok speaking to us from Seoul. And in response, we did hear from the company and Samsung saying that it remains committed to engaging in good faith negotiations with the union and is currently producing as planned with no problems meeting or responding to customer needs. We got plenty more ahead. This is Bloomberg.
The economy looks as if it's slowing. The labor market looks as if it's coming back to normal. Inflation looks as if it's coming down.
This is one of those times where, okay, the Fed is going to cut rates. We've been clamoring for cuts. Is it actually a good thing, though? And I think that's what markets are really dealing with.
I think they should go in September.
I do think they will start to cut in September.
They just need to be steady as they do this.
I still think that they'll start with 25 so as not to scare anybody.
If they rush it, it's going to actually look like they're scared about something.
If they move too quickly, the expectational set in the market could get ahead of themselves.
I still think September, December, March, June, September, December. 6 rate cuts, 1.5 years, I think that's what they should do.
Go slow, take your time. You've got a winning hand. Why would you do anything today or potentially September to destroy that winning hand?
Well, clearly laid out there, the doves and the hawks there as far as the outlook is concerned. Some of the voices, of course, we spoke to following that cooler than expected US CPI print, which led to, well, a drop in the US dollar and, of course, where the yen is trading. So we went from, we fell a full 4 yen and change from 161 to 157. So we're retracing slightly back to the upside, not quite back to the midpoint. Conversations now, did they intervene, and comments coming through out of the Mr. Suzuki there?
Yes, the finance minister is still saying, not commenting on this report of the BOJ rate check. That was something what the Nikkei was reporting as well, and refrain from evaluating recent FX levels. So they're still saying no comment right now. Maybe just wait till the end of the month to see if they did intervene or not. But look at the Hang Seng rally continuing on here. We're up about 350 points right now. Plenty more to come. This is Bloomberg. Welcome back to the China Show. Here's a look at the HSI a half hour into the session, and there you go. We are punching gains of about 2% here right now, so sort of a repeat of what we saw yesterday, given that we've seen this rally continuing for a second day here. This US CPI report seems to be benefiting a lot of the tech names in China, which is a bit of a flip, I guess you're seeing in terms of flows here from mega cap US tech to maybe more of a rotation into HS Tech here this morning. So that certainly is helping the index overall, Dave. And we're just still waiting for those trade numbers coming out of China.
Yeah, which could come out at some point this hour. We'll get you those numbers, of course, once they do break. And at some point over the next few days, we should be getting the credit numbers, of course, for the month of June. We are in the window for that going into the third plenum next week. I suspect, and this is just my personal bias, given when this typically comes out, the trade numbers, I'm going to bet that the numbers come out either at 6 p.m. today or around 10 a.m. tomorrow. Anyway, well, let's see who's going to take that wager. Right, as Yvonne is pointing out, right, so we're getting a very strong weight across Hang Seng Hong Kong markets, which really underscores, by the way, how uncorrelated this Chinese equity market has become to global equities, which pulled back overnight. You're seeing major chip stocks in the region pull back substantially. Today, 8% on Disco, 4.5% on TSMC, SK Hynix, Tokyo Electron, Samsung's also pulling back about 3%. And this is pulling down the entire benchmark today on those markets and across the Asia Pacific. And you look at this next board on your screens, it's coming up shortly. Nikkei's down about 2%. The Krosby, the TAIEX index is also down quite substantially too. TAIEX is leading losses to the downside, 2.2%. The rest of the region, though, doing okay. We are still poised for a third week of gains across these markets, and it's really this move into bond markets, which is quite pronounced, of course, following the
you had the
CPI
U.S.
print.
two-year yield was low as nearly 11 basis points.
Yeah.
So certainly you're questioning a lot, really, whether we should buy into or lean full into this whole steepener trade. Citi has an interesting note saying that is possibly the best way now to capture maybe some sort of return leading up to this U.S. election, also leading up to these Fed cuts as well. Let's bring in Quincy Krosby, Chief Global Strategist at LPL Financial. Quincy, it's great to have you on the program. I mean, it's interesting. We're seeing a bit of a shift away from tech into some of these value stocks in the U.S. after this US CPI print. I'm just wondering, how much scope do you still see that asset prices can actually rally from here, given that a lot of these sort of Fed cuts have been priced in already?
Well, what's interesting is the movement out of big tech, right? And then we saw going into the Russell 2000, which is the small and mid-cap names. The Russell moved up over 3% today, which is interesting because on one level, the Russell and the small and mid-cap reflect potential rate cuts. They are very rate sensitive. But there's another element, and that is they also are a barometer for economic conditions. So what's interesting about all of this is what is the Russell 2000 seeing? Because when we saw that drop, not just in the CPI report, but what you just mentioned, the drop in the yields, especially the 2-year yield, which is the policy sensitive, and the 10-year, it came down very quickly, which makes you think, wait a minute, maybe it's seeing a potential slowing down in the broader economy. So the question then becomes, would the Fed have to come in and cut rates maybe even before September, if in fact this affects the labor market and we see the unemployment rate rising even more? And that's where you have the question as to, will money then go back into big tech? That's what I wanted to point out, because big tech, mega tech has been basically an island unto itself, an island of safety for investors.
Right, and that's interesting that you phrase it that way, Quincy. David here, by the way, because if indeed what we saw overnight was a turn and not simply repositioning, a turn in that hedge of going into AI because that protects her from everything else. Do you think that continues? Do you think we will see the Russell 2000 and the like continue to outperform moving forward from here, or was that a blip overnight, you feel?
Well, there has been much discussion about investors wanting to go into the Russell because they are obviously attractively valued. There are many names in there that belong to the financials, which also, oddly enough, you think financials want to have higher rates, but they want rates that aren't going to scare off, people coming in for loans. Or, in other words, it becomes a positive to have the rates come down. So that's the biggest question, is whether or not this movement was really because the market thinks that the Fed may have to cut rates, not just because of inflation coming down, but because the economy is cooling too much. Then it goes back into the big tech names. And by the way, the expectations are that they are still going to deliver very strong earnings. Maybe not enough to warrant those valuations, but that the earnings and the guidance will still be maybe not stellar with a capital S, but still stellar.
And if the question is now a slowing economy versus just slowing inflation, Quincy, then what happens to this easing cycle? I'm just wondering, the market's pricing in 2, maybe even 3 now. There's a question of that. What does 2025 look like to you, too, when it comes to this timeline?
Well, I think when I look at it, I think of Powell invoking the mandate for employment, full employment, maximum employment. He's been invoking this and mentioning it a number of times. And he has said also that if the labor market, he used the word deteriorates, they will come in and cut rates. If that were to happen, and if we see it at the next, payroll report, he may just come in before September 18th, which is when the market is pricing in a rate cut because of inflation coming down. This is what I think many of the analysts are saying. You know what? The market wants the Fed to cut because inflation is coming down. But then you've got to ask yourself, is the market actually going to be pleased that the Fed cuts rates because the economy is slowing? The answer is no, because historically, when the Fed pauses, as they have been, the market tends to do very well. When the Fed cuts, typically the market doesn't do well. And the reason is the Fed typically cuts because the economy is under pressure. That's the big question right now.
Right. And does that then place bonds in a much more favorable light than we think? Because if the equity market has indeed run its course, and if they cut over the next 3 months, okay, at best the equity market has 3 months, let's put it that way. Will that shift lead to bond markets doing well when the cutting cycle, as you point out, gets on in earnest?
Well, yeah, I mean, what's going to happen then, now you're looking at short duration, but if it continues to come down, you'll see a move into, I think, in the belly of the curve, the 5-year, for example, and then move out. What's also interesting about this is that utilities have actually done very well. Utilities have actually now not just been about utilities, and I'll go into utilities because I need yield. The rates are coming down, so now I'm going to position myself to get those yields, right, through utilities. But also the utilities have been historically where you go in and they see the top of the bond market. That's been a historical pattern for utilities. More and more, though, I do want to add, they're seen as a complement to AI, because you've got to get those grids going. You've got to get the power going for those data centers.
Quincy, I want to get your take. I know before you joined Wall Street, you were actually a diplomat for the U.S. So maybe you've been covering and watching what's been going on with this U.S. election campaign. And obviously, we just had that press conference from President Biden where there were some gaps, but certainly a lot of questions lingering about this re-election bid. What was your take on this? I mean, and how is the best way to position leading up to this U.S. election now? Do I start introducing some of these Trump trades back? Obviously, some people have been talking about steepeners. That could be the best way to capture that now.
Well, yeah, I mean, it's interesting because once the issue with Biden came up, and then Trump became, the favorite, for a short period of time. Yeah, what you saw was the bond market reacting like, oh my goodness, we're going to have bigger deficits. We're going to have lots of tax cuts, bigger deficits, and suddenly we saw the yields move accordingly. What we're doing is we tend to look at it in terms of sectors and which sectors would do well under a Trump administration and which sectors under a Democratic administration, Biden or whoever the Democrat is. But then again, what we've seen historically, I think, more recent history, is it also depends on who takes over the Senate and the House of Representatives. That's where you get the real impact of an administration or the White House. If they can take a sweep and sweep the entire system, then you'll see the market really converge, not just on tax cuts, but also on all of the sectors. For example, with Trump, it would be, as I think everybody knows, it would be financials, it would be energy. There were a host of other sectors which would do well under a Republican administration, but especially if they were able to, have a clean sweep.
Quincy, thank you so much for taking the time to speak with us. Fantastic insights. Let's do this again, please. Quincy Krosby, their Chief Global Strategist at LPL Financial. Right, just ahead here, just on that note, as scrutiny intensifies or even pressure intensifies on President Biden after high-profile verbal stumbles a couple of hours back, we'll discuss the implications for his re-election bid and campaign just ahead. This is Bloomberg.
Now I want to hand it over to the president of Ukraine, who has as much courage as he has determination. Ladies and gentlemen, President Putin. President Putin. He's going to beat President Putin. President Zelensky. I'm so focused on beating Putin, we got to worry about it. Anyway, Mr. President.
I'm better.
You are a hell of a lot better.
What concerns do you have about Vice President Harris's ability to beat Donald Trump if she were at the top of the ticket?
Look, I wouldn't have picked Vice President Trump to be vice president.
Yep, that pair of gaffes there, certainly by the President Biden earlier today, certainly is the highlight, it seems, and really overshadowing some of the things that we heard in terms of policy during that press briefing, as well as we wrap up this NATO summit as well. So certainly adding to more questions about whether the future of his reelection bid. You certainly take a look at what the betting odds are what is looking like here right now. And Dave, you certainly saw there was a bit of movement during that press briefing too.
Yeah, there was a movement from the time when the initial verbal gaffe came out on the President Putin. You had a spike up in the odds for Kamala Harris, and then you had it pull back a little bit during the actual press conference as he was going through some of the policies and everything else, and then you had a reacceleration in Harris again following well, interesting enough, the confusion with Kamala Harris and Donald Trump as vice president.
Yes, let's bring in Derek Wellbing there in Singapore. Was I'm sure watching that press briefing really closely, and certainly, there was those two pretty pivotal sort of moments there. Overall, though, how do you think the president did?
Well, Yvonne, I think it's one of those things where this press conference isn't one that necessarily convinces Joe Biden that he needs to get out of the race, but it's also not one that stops the call of people in his party who are looking for him to have second thoughts. Indeed, we have seen since the conclusion of that press conference, 3 different members of Congress come out and call for Biden to step aside in the presidential race. So that drip, drip, drip has not abated. It is not a surge yet, but it is not nothing either. And these sorts of things are ones where everything happens very, very slowly and then all in a rush at some point. So in the meantime, we're watching every single one of these moments to see how he's going to do. Certainly the 2 clips that you played at the top of this are 2 of the top things that are on mind. And I heard one Democratic lawmaker say, look, the rest of this press conference was really good, but every single time this is what we're talking about. What we're not talking about, the headlines that came out of this were not about NATO trying to do more for Ukraine. They were not about the risks that the U.S. and its allies see about some of the ways that China is operating the world. That's not what we're talking about here. And indeed, the other thing that a lot of people aren't talking about is what Trump is planning to do, what he would want to do, what his policies are. So I think that the White House has this difficulty where every single moment that they go forward, it's all about Joe Biden's optics, whether he's going to have some verbal trip up rather than where they would actually want the conversation to be. And that is a really big problem, especially when you're already down in the polls.
Yeah, I mean, to your point, Derek, you don't hear about the times you do your job. You hear about the times you don't, and you get constantly reminded of that. To your point on what the optics look like, he did dig into, of course, that he is resolute in continuing this campaign, didn't he, President Biden?
Yeah, and I thought it was really interesting. Our Josh Wingrove had a question in there, and one of the things that Biden was saying, he seemed to sort of shift the window of his own deliberations, right? He had previously said that he was only going to get out if God told him to, which is a very high bar. But he sort of clarified here and said, if my advisors came to me and said there's no way for you to win, then I'd think about, and that is a meaningful shift. But he also said no one's said that, and he said multiple times throughout this press conference some version of like, look, it's not going to happen. I'm in this. He was very, very clear. He's in this race. This is where he's going to be. The other thing, though, I'll tell you what, David and Yvonne, the other thing that sort of stuck out to me in this was he was asked about Kamala Harris and his thoughts on her, and he did say, you know, he thought she was quite strong. He thought that she was ready to be president, and that he wouldn't have picked her originally if he thought that she wasn't. So it was really vocal and unequivocal support for his vice president and her potential future. There has been some chatter about whether or not Biden is staying on because he's not sure that Harris can win, and Biden was very, very effusive in his praise for his number two.
Derek, well, back in Singapore for us there, just wrapping a fairly eventful last couple of hours there, of course, over in the U.S. Right, there's plenty more ahead, including a look at really some of the big moves in his equity market. As you can see, the Hang Seng is clearly moving against the grain in the Asia Pacific, up 2% in the first hour of trade. This is the China Show. Welcome back. Let's get to the latest here on this ongoing strike with Samsung. So the leader of the largest labor union of the company says the strike action is disrupting production and causing equipment to go idle. The union chief, Son Woo Mok, spoke to our colleague Sherry from Seoul about why workers have walked off on the job.
It's been a long time since we've been negotiating, and it's been a year since 2023, and we haven't been able to sign a wage agreement. Despite that, and despite the fact that we've launched an indefinite general strike, the company seems to be thinking that they can win if they keep biding their time. We're going to continue with the general strike until the company comes forward.
Where could you find compromise to get to a resolution?
Since starting the wage negotiations, Samsung has never negotiated properly. We haven't been able to get a good negotiation in 2023 and 2024. So if we're going to get a deal this time, we basically need a pay raise for our members. We are not asking for many things. The company unilaterally announced 3% increase, but we are asking for a little higher, 3.5%. There is no transparency about the bonus pay system. So there are many complaints from employees there. So we are saying, let's improve the system with transparency. And for the most important, holiday rights, we're asking for 1 day for the union's establishment anniversary. So if we can get a resolution here, I think that's something we can agree on. And I don't think that we're asking for anything unreasonable.
Your union has targeted production disruptions, but Samsung says that they haven't seen any production disruptions so far. How will you achieve your goals then?
We're getting a lot of reports from the field. Like in the 8-inch manufacturing, a lot of current shift workers, people who work in manufacturing, a lot of them are on strike right now. So we don't have enough people to manufacture on that line. It's a manual line, so it's not automated. So that's where you need people. And they're taking a lot of people out of the office right now. And I know that they're not responding properly. And in another line, I'm hearing that there's a lot of equipment that's shutting down, but they don't have the manpower to handle it. So there's a lot of equipment that's going idle. And when you're producing semiconductor parts, obviously you have to do inspections and things like that. And there's a lot of that backlog right now. So there's definitely going to be quality issues.
We heard your union is getting advice from a former union leader at Hyundai. What sort of guidance are you getting from unions of other conglomerates in South Korea?
Oh, we're cooperating with other unions as well as Samsung-affiliated unions. And we're working with the Korean Metal Workers Union, which is where the Hyundai union is. We're getting a lot of help. And we're getting a lot of help from unions that have a lot of experience in this kind of thing, because we're a new union, and we're leading this general strike with that help. We're going to continue to expand our solidarity with other organizations in the future.
Samsung workers usually get higher pay, also higher benefits than workers at smaller companies in Korea. Are you concerned that the rest of the country might not really sympathize with your demands, especially at a time when we know that Samsung semiconductor exports could actually help the broader Korean economy?
We're not worried about that. We're in a labor movement, and I think it's fair to say that we're fighting for the rights of all workers in Korea. Samsung Electronics is known as the best company in Korea. And if the wages are not raised properly, even at the best company, then the countless suppliers and small and medium-sized enterprises under them will not be able to get a proper wage increase. So if we raise the wages, then other companies will have a cascading effect. So Samsung Electronics is at the most important crossroads to raise the wages of the most important workers in Korea.
National Samsung Electronics Union head Sung Woo Mok there speaking to Sherry from Seoul. And it really, in response, we did hear from Samsung saying it remains committed to engaging in good faith negotiations with the union and is currently producing as planned with no problems meeting or responding to customer needs. We've got plenty more ahead. This is Bloomberg.
Happy Friday and welcome back. You're watching the China Show, a live look at Hong Kong Island from across the harbor, of course, and we're going into the weekend with at about 20 to 30 degrees. There's a lot of precipitation out there. Humidity is at a nasty 90%. So I guess stay indoors, or if you're an outdoor sort of person, do you. As they say. 1.8% to the upside there in the Hang Seng Index. Dollar China, as you can see, some weakness coming through in the Chinese currency. Right, let's focus in on what's happening here in Hong Kong and, of course, this Greater Bay Area project. This new report, or the latest of this report, has found business sentiment in the GBA area holding up, indicating steady economic momentum. And the GBA is Beijing's plan, of course, to integrate, or to closer integrate 11 cities around the Pearl River Delta, including, of course, where you are with Hong Kong and Macau. Now, a survey of around 1,000 companies, as far as the sample conversation is concerned, they also found that expectations around business activity rising for the first time in 5 quarters. That's the positive spin. Let's get into the numbers and what this means really underneath all these top-line numbers. Joining us here on set are the co-authors of the report, Standard Chartered senior economist Kelvin Lau, and also joining us here on set is Hong Kong Trade Development Council Director of Research, Irina. Thank you for joining us on set. So let's start with Irina, and let's start with both of you. How would you guys describe sentiment? So there's a number. What does a number mean?
Okay, so I think the current performance as well as the expectation index goes well beyond 50 and is anchoring around 54, okay. And then it's at similar level as last quarter. So I would say it is showing the strong momentum, continued, sustained.
If you break it down then, Kelvin, what are you seeing? It's city by city, sector by sector, what is it?
Sure. I think there are 3 key messages. Number one is that, as Irina mentioned, the headline number is pretty steady. That shows us that the growth momentum of China has been extended from a decent sort of speed in Q1, extended into Q2 as well. The second component is the breakdowns of it, as you mentioned, the cities, by industries. Those are showing some interesting nuances. For example, the improvements in production and sales, new orders, profits, those are more prominent compared to the laggards, which is the financing appetite and investment appetite. So not each area of the economy is doing well. Some are weaker. In terms of city and industry, again, one of the underperformers this time is the I&T, the innovation and technology. And I think that really reflects the timing of the survey, which was done back in May and early June when all those tariff concerns are coming back. So I think that really hurt the sentiment back then.
Yeah, just to pick up on what Kelvin said, Irina, let me bring you back in. On the weakness in the tech space, in IT in particular, what is sentiment like among these companies that, I guess, procure some of their supply chain from outside China, for example? And is that a problem, for example?
So I would think it just during the time of the survey periods that we do see a lot of conflict. For instance, U.S. and EU imposed tariffs on the EVs, and even today we have news about telecommunication. So for the GBA, I think it's a very strong production base for electronics-related products.
Yep.
So which is also tech-driven. So I think all this will affect the business sentiment. But as Kelvin have just mentioned, if you look at some of the real performing indicators like profitability, new orders, production and sales, they're actually doing quite good. But, it may be that some external factors at that point of time that, throwing news a little bit affecting the sentiment. So IT-related sector will be most, the one most being affected.
Well, what are the whys? Why are they? To what can we attribute? Why are things going so well? In that, I really start with you.
I would say real business still doing good. Okay. But then, when you, come across with the news that maybe you will be a bit concerned. So that's why, even though all the indicators will perform doing good, the expectation does not really go very well, given the very good, profitability index actually go to close to, I would say it's over 60. That's a very strong number, and even for expectation and for current.
Yeah, and Kelvin, one of the things that when you hear about these trade tensions with Europe, with the U.S., is that they talk about overcapacity coming from China. How concerned are the businesses that you talk to about this, and does it deter them from investing?
Yeah.
Or even upgrading their equipment, whatnot.
Yeah. Well, thanks for bringing that topic up, because I mentioned 3 things that I want to talk about, and I forgot about the third thing, which is exactly that, and that is industrial upgrading and the buzzword about new quality productive forces. Yeah. One of the key findings this time around is that we also take advantage of this 1,000 sample size every quarter to ask some thematic questions. And this time around, we chose the new quality productive forces. And one of the key questions that we ask is how worried are our respondents when it comes to some of the new industries facing overcapacity. And the results are pretty encouraging, and that is only around less than 12% of the respondents says they see it as a high risk of new industries seeing overcapacity. Another 30-something% says yes, some risk, but not high. So I think overall, less than half of the respondents see it as a concern of varying degrees. So I would say that if anything, I think it's one of the main drivers of the resiliency of the GPI index this time round. Going back to David's question, and that is what has been driving this solid performance, and that is all this push towards equipment upgrading and the production boost coming out from it has been offsetting some of the key headwinds like housing sector, so still struggling consumer spending sentiment, all these other things.
Any insights on hiring plans and also labor availability, for example?
Skills.
Yeah.
Those are more relevant to the previous surveys where we specifically asked about hiring appetite. Okay. So those are really relatively steady, I would say, not strong. But this time around specifically, I would say that the concerns are more towards the impact from the new quality productive forces. And one of the potential benefits that our respondents saying is that all these policy push for innovation could actually help them easier to find the right personnel to drive their new innovation agendas. So one of the key benefits that they are hoping to see from the policy push.
Irina, I was going to ask you about Hong Kong specifically and maybe their role in this GBA, because I'm looking at some of the sentiment and some of what the sub-indices are saying. And when it comes to business activity, when it comes to credit conditions, the like, I mean, we're seeing Hong Kong in the low 40s. And comparatively speaking, weaker than the rest of the GBA cities. What does that tell you about the future of Hong Kong, and what role does it play in GBA?
So I would put it that way, because for this GBA index, we look at different sectors. Currently, for instance, one of the drag, on the Hong Kong's indices is actually the retails. So because we are pegged to US dollar, so that compared with now neighboring area that our goods are relatively more expensive. So the consumption part try to throw to for instance Japan, right? or even to China because of the relatively cheaper currencies. And the other thing is about U.S. dollar. The interest rate is right now is close to, I think, 17, 20 years high. So that's why it also makes the financing cost a little bit more challenging for Hong Kong companies. But the good thing is that we are now seeing even today the US CPI numbers is a little bit softer than the market expected. Probably that's something good for around the interest rate, and then probably if you translate into a weaker US dollar, then probably that will do good better to our one of the key sector, the main drag.
Yeah, all roads lead to the Fed, doesn't it? All the time. As a follow-up there, I mean, it seems, and we've heard this from you right now. We've heard this anecdotally, that it is cheaper across the border to do many other things than it is here right now. And I'm wondering, from a policy perspective, is there something that Hong Kong can address to narrow that gap, to keep consumers and buyers and shoppers here in the city, for example? Because to your point, the reason this is so low is because no one is shopping here, no one is spending their money here.
Well, I would think we will expect this to be a cyclical issue. So
it's only cyclical.
Yes. Okay. So if as I mentioned, if the U.S. dollar translates into a weaker currency, then we will make more, I would say, competitive to spend here. And then I think the government is also stepping up a lot of mega events that really target different tourists as well. I think that's also be a very good attraction. But on the business side, that actually, if you look at TTC related, we do a lot of exhibitions and trade fairs. So our visitors numbers are actually doing very good. So on the business side, it's really, I think that so long as you have real, genuine business momentum, people are coming. Yeah.
Real quickly, Kelvin, is it really cyclical, you think, this Hong Kong story? Or do you think it's just at risk of becoming just another Chinese city?
Certainly, I think it's the former, as Irina said, it's more of a cyclical story. If you look at the unemployment rates, if you look at the income growth, those are still very, very positive. So it's all about trying to keep a lot of those that can spend to stay in Hong Kong and spend, and also attract new spenders to come back to Hong Kong to spend. So these are more policy-driven, and it could improve over time when the currency is much more favorable, for example. So, but fundamentally speaking, yeah, people can spend. The ability to spend is still there.
Kelvin, thank you. Fantastic. That was Kelvin Lau, their Standard Chartered Greater China senior economist. Also, our thanks to Irina Fan, Hong Kong Trade Development Council Director of Research. You can get an insider's guide to the money and people shaking up the Finance Hub in our Hong Kong edition newsletter that's out every Thursday. You can sign up through the website, bloomberg.com/newsletters.
Right, just ahead, a new nickname is taking root among some online Chinese investors, suggesting frustration in this equity market. The details of that in our entire China brief is just ahead here in shows. This is the China Show.
Here's your China Brief. A look at what's making headlines in national newspapers today. And state media is painting a rosy picture of the economy ahead of next week's third plenum. The Securities Times has published results of its survey of 61 local economists, and it shows that most respondents see growth remaining stable and the property market recovering in the second half. The respondents also said and expect policymakers to clarify reforms and boost market confidence at the plenum. And speaking of reforms, the China Securities Journal is flagging a potential overhaul of the tax system. The paper quotes experts who expect a reform of the consumption tax to boost local government incomes. One economist also suggests making adjustments to individual taxation to address income disparities.
So that's in papers. Meanwhile, on social media, retail investors are signaling their, let's put it, their frustration with a struggling stock market. Let's bring in our Asia government and politics correspondent, Rebecca Chung-Wilkins, to talk us through what she's seeing on social media and walk us through exactly what they're talking about here, Rebecca.
Yeah, absolutely. So this is a trend spotted by my colleague in Singapore, Josh Xiao, where more and more social media users referring to themselves as 金融消费者, essentially calling themselves financial consumers. Now, this is a term that was used by the regulators to reassure people that they protect people's financial interests just a couple of weeks ago. But now what we're seeing are the emergence of these videos on social media. Behind me, this one on Douyin, viewed 14,000 times, where people are saying, we are no longer investors, we have a new nickname, we have a new name, and that is a financial consumer. And our job isn't to think about profits, but to think of ourselves as consumers spending money. So quite a big shift in how people are talking about it, this sort of pessimism and frustration. And then also on Weibo, we also see the emergence of some of these sort of more sarcastic social media posts emerging. So, for example, people commenting that although the vast majority of Chinese stocks are falling, asking, well, there are a handful that are rising. Are we maybe on the precipice of a bull market? We see other sort of more sarcastic commentary from other posts referring to themselves, again, as financial consumers. They are saying that our job is to support and spend, and if we are consuming financial markets, we are supporting the country. And if we are consuming financial markets and supporting the national team to make money, again, we are supporting the country. So sort of sarcastically urging people not to worry, not to be anxious, not to be concerned, but just to get spending. And this sort of disillusionment, this sort of pessimism and this anxiety really speaks, I think, interestingly to me, to the sort of mood on the ground a little bit as we head into the plenum among some of those 200 million mom and pop investors across China who have gotten so used to the poor performance in Chinese stocks. Also, fundamentally, this issue of confidence that is really lacking.
Yeah, you mentioned so financial consumers. That's interesting. That's a broader reflection of how people are feeling in China, Rebecca. You've also been reporting about how incomes are actually growing more slowly these days and leaving some feeling poor. What are some of the surveys saying now?
Yeah, my colleagues and I have done a lot of reporting on this in the past, but this is a fantastic, new, really insightful survey led by a collaboration between CSIS and professors from Stanford and Harvard, looking at how people have changed their views on inequality and their financial prospects over a period of nearly 2 decades. And we do see this remarkable shift here. So this one particularly looks at the reasons people attribute to becoming rich in China. You can see back in 2004, it's really about meritocracy, ability, talent, a high education. Now, fast forward to now, 2023, a big shift. People really seeing that it's down to connections and growing up in a rich family. That's particularly striking because actually in the period of 2004, we were coming off a period in China's history where inequality had actually really blossomed and really expanded versus today where we've seen a relatively sort of stable line by comparison compared to the 80s and the 90s. And yet these big perception shifts are happening across the country, particularly given some of the difficulties in accessing insights on the ground and surveys. I think sort of research like this really helps kind of understand those more sort of seismic shifts about how people are viewing perceptions, how people are viewing their financial prospects. This shift essentially from thinking 20 years ago, if I just kind of raise myself up by my bootstraps, I can make something of myself, to now being a lot more sort of pessimistic and pointing to these structural, societal and socioeconomic reasons why they can't quite make it.
Yeah,
Rebecca.
Guanxi.
Huh?
It's all about the Guanxi.
It's all about the Guanxi, as you say.
Well, you know? Yeah.
I thought it always was, but anyways.
Yeah, maybe more so now.
A bit of a change, yeah.
Rebecca, fantastic. Yeah, Rebecca Chung-Wilkins there. Deeper dive into today's China brief there. All right, plenty more ahead. We'll get you an update on these markets. Hong Kong is doing extremely well, but that seems to be one of the few positive stories across these markets. This is Bloomberg. Right, okay, so we are doing extremely well across markets in Hong Kong, but as you can see, the pullback and the profit-taking we're seeing across some of the big winners recently, chip makers, TSMC, Samsung Electronics, and of course over in Japan with a stronger yen that's taking place, dragging on the overall index lower, although we are poised to still end the week higher on equity markets in the region. Yeah,
it certainly is that big shift that we didn't quite expect from big tech out of the U.S. That's really why we're seeing those outflows coming through from Taiwan, from Seoul, from Japan in some ways here this morning. But that stronger yen obviously is also not doing quite well when it comes to equities there. But Hang Seng is the clear standout, as you say. And we talk about that sell-off in big tech. Where we saw it was really in the likes of Tesla shares as well. We saw a drop about 8%. after, not just with this shift in, out of big tech, but also, according to our Bloomberg sources, this postponement of unveiling of its Robotaxi until possibly October now. Now, this is what our sources are telling us, that the car maker wants teams working on the project to have more time to build additional prototypes. Optimism over the launch, originally scheduled for August, had contributed to an 11-day streak of gains for that stock.
Now, as the stock dropped, fittingly enough, we were speaking with Cathie Woods. You might know her, of course, from ARK. She's a very big Tesla bull and Tesla investor, too. And what she thinks of what this delay means for the project and her outlook, too, for the stock in general. Have a look.
Normally, we will start taking profits well before 16%. But the reason we have let Tesla run, we've taken some profits, but let it run to a higher percentage than normal of the portfolio, is because that Tesla is about to give us a lot more information about the Robotaxi opportunity. Now, originally, August 8th, so 8/8, and I know in China that's a very lucky number. And we thought that that's why Elon chose the date. At first it was August 8th. Today they pushed it to October. And that just tells me that we're probably getting closer to this robo-taxi opportunity, not further away. He wants to show us something more, I think, awe-inspiring than we might have seen on August 8th, and he believes it's possible by October.
Yeah, just some context there. We were speaking with Cathie Wood in a recording for Tiger Money, and so I noticed that Tesla was, many people know this, her biggest holding on the strategy, and it's actually at 16% when the mandate only calls for a maximum of 10. So I asked her, why is it at 16? She said they haven't taken profits, so she's still bullish on the stock.
Yeah.
Suffice to say, but we know that already anyway.
It's interesting, too. We'll see how it all plays out next week, obviously, and whether this kind of sell-off in big tech can continue. As our guest, Quincy Krosby, said, is this a start of something where you're starting to see some of these other parts of the market catch up, like the small caps?
The Russell 2000.
And the like. Yeah, but next week's going to be busy, right? We talk about the Plenum, we talk about data dumps in China, but yeah, I think globally speaking, there's a lot going on, right? I mean, you're watching the Euros, right?
Yeah, so I will worry about worry about the Plenum and everything else next week, and the data dump and everything in between. So Sunday's actually a pretty big day as far as sports, as they say, hashtag sports. So I think it's actually, I could be mistaken, I think the Euro final and the Copa America, which is, of course, between Argentina and Colombia, are taking place. I think they overlap for about an hour. I could be mistaken. Let me just check Google on this as well. But yes, the question is football coming home? Ooh. Coming home to Spain. So, yeah.
Don't say that to the Brits out there.
No, well, either way, they'll make a fuss. But yeah, and of course, it's also the Ambani wedding.
I'll be watching that more. Okay, yes, I like the Wimbledon, but not so much football. Sorry about that. But yes, this Ambani wedding. How many days has it been? This is like the longest wedding ever been covered, right? I think it was like 150 some days, I think our BN team was calculating. It's finally coming to an end, and the big event's happening. And these are the guests of honor, I guess, or at least who our sources are telling us are on that guest list and expected to attend. So of course, you got your typical CEOs, C-suite. You got Mark Tucker from HSBC. But yeah, we focus on this, for me at least, the celebrities.
No, Kim Kardashian is...
and Khloe, too.
Is coming. And Khloe.
Who would you sit next to in that wedding? Or who would you want to be in the same table
I would definitely... Well, I know who I would be staying away from. I would be sitting very far from Mike Tyson. I'm kidding. He's a puppy now. He's a pussycat. I love Mike Tyson. Who doesn't love Mike Tyson? But yeah, I'm guessing you'll be sitting next to David. You do every day, but another David.
I was like, which one? Yeah, maybe just for a weekend, David Beckham. That'd be really nice. He could be my date.
There we go.
Or John Cena. He looks like he'd be fun at weddings.
I think so. I think so.
We should be really talking about the CEOs. We should be sitting next to them for our jobs.
Well, there's one CEO who was there as a CEO of this next stock that's about to come up here. Jay Wiley's actually attending. Yeah, and there's a strike ongoing. There's a strike in markets today when you look at Samsung. It's not here on your screens. We're down about 3%. Chip stocks in general are also doing quite bad. Also, airlines out of China, the big three out with some prelim numbers. And as you can see, we're seeing a pullback there following that guidance coming out of the airlines ahead.
Yep, so not looking too good when it comes to the airlines. We're going to talk a lot more coming up. That's it for us, though, here on the China Show. Bloomberg Markets Asia is next. Have a great weekend.